The stock market has been crashing recently. Even though it rebounded a little, it still reached correction levels. So is this decline going to continue? Well, there are a lot of things that can go wrong, so make sure to watch all the way until the end. First, we have to understand why the market started crashing. On March 3rd, 2025, President Trump announced a 25% tariffs on all products imported from Canada and Mexico. This started bringing fear and uncertainty to the market. And when there is uncertainty, people start selling their stocks, which slowly led to the correction we have now. But what will happen next? Will this correction turn into a full stock market crash? Well, to find out, we have to look deeper into what Trump plans to do with these tariffs and how big of an impact they could have on the stock market in the long run. Trump's tariffs are generally aimed at protecting domestic industries by making imported goods more expensive, encouraging consumers to buy American made products, which should be great for the Americans. However, this will mean that products which are imported from other countries will get increasingly more expensive. And if you were to make these products inside the United States, the cost of making them can be far more expensive than what it would be if you made them in other countries, making the price go higher, finally hurting the Americans in the end and raising inflation. But how is this affecting the stock market? Well, besides stocks falling because of uncertainty and fear, stocks of companies that rely on international trade may take a hit due to reduced global demand and higher costs. Businesses that depend on imported raw materials will see their expenses rise, which can squeeze profit margins and lead to lower earnings reports, something investors don't react well to. On the other hand, some domestic industries like steel and manufacturing could benefit in the short term as they face less competition from cheaper imports. This might cause certain stocks to rise, creating a mixed market reaction. However, if tariffs escalate into a full blown trade conflict, the overall market could suffer from prolonged instability, slow economic growth, and weaker corporate performance. In the long run, while some sectors may gain, the broader economy and therefore the stock market could struggle under the weight of higher costs, trade barriers, and reduced global trade opportunities. Now, to find the answer to if a trade war will happen and if the market will crash, we had to think like famous investor Charlie Munger, and here we want to look at three approaches. First, probabilities. What are the chances of these events occurring? To figure this out, we need to look back in history and see when the last trade war occurred and check if there are any patterns that we can use today to assess the likelihood of a potential trade war. The last major trade war was in the 1930s during the Great Depression, with the passage of the Smoot-Hawley tariffs in 1930. This led to other countries imposing tariffs on American goods, which severely disrupted global trade. The consequences were dire. International trade plummeted, and the global economy took a significant hit, deepening the Great Depression. The pattern here shows that trade wars can escalate quickly with global consequences that are hard to reverse. Looking at today, the world economy is more connected, but some of the same issues like protectionism, economic nationalism, and trade imbalances are still around. However, today's global system, including organizations like the World Trade Organization, might help prevent things from escalating. The likelihood of a trade war depends on whether countries are willing to take the risks of conflict in such a connected world. In my opinion, we likely won't see a trade war, mainly because Trump values his reputation and probably doesn't want to see the global economy suffer. One of the things he often highlights from his previous time in office is how well the market was performing, and he likely want to maintain that positive image. Additionally, other countries would be eager to avoid a trade war as well. So if Trump decides to end the tariffs, they will likely be quick to follow suit and de-escalate the situation. The second way of thinking about this is to invert or think in reverse. And there are a few ways to apply this when considering a stock market crash. Instead of focusing on which stocks will go up in a market downturn, I would approach it by asking which stocks in my portfolio are most likely to go down. By doing this, I can prepare myself psychologically for those declines and, if needed, be ready to buy more of them. For example, Canadian stocks that might be negatively impacted by tariffs could be a part of this group. Once we identify these stocks in our portfolios, we shouldn't rush to sell them unless we believe their business model is fundamentally broken. It's not 100% certain that these stocks will decline, and selling based on emotions is a mistake. Instead, we should hold on to these stocks for the long term. Short-term news and market fluctuations are likely to calm down over time as long as the business is generating stable free cash flow and remains a high-quality company. Selling would be a poor decision. In the long run, these stocks are likely to outperform the market, and keeping them in your portfolio could prove to be a wiser move than reacting to short-term market fears. The third and final way of thinking is something you can apply during a market crash: avoiding dumb mistakes. This is a broad concept, but to be more specific, it means steering clear of errors that can easily be avoided in investing. For example, we don't want to let ourselves be influenced by short term news and price fluctuations. Just like I mentioned with the Canadian stock example, it's crucial to stay level headed and not react emotionally to market swings. During a crash, emotions often take over as we see our investments lose value, making it tempting to panic sell or make irrational decisions. That's why sticking to fundamental principles, ones that should become second nature, is so important. If we stay disciplined and avoid simply but costly mistakes, we'll be in a much better position to navigate market downturns and come out stronger in the long run. So, to conclude, is the market really going to crash? Well, if I had a crystal ball, I'd know for sure, but unfortunately, I don't. What I mean is that predicting a market crash in the short term is extremely difficult. However, if I were to be completely honest, it does seem like that we could get one. Besides Trump's policies, another major factor contributing to a potential crash is the S&P 500's PE ratio, which is currently trading around 27.5, an extremely high level, almost reaching the valuations seen during the dot-com bubble. Now, as Warren Buffett and Charlie Munger have often said, history doesn't repeat itself, but it often rhymes. While we can't say for certain that the market will crash, we also shouldn't ignore clear warning signs. But even if a crash were to happen, we should see it as an opportunity rather than a catastrophe. A downturn would allow us to either buy more of the high quality stocks already in our portfolio or pick up previously expensive quality stocks at a discount. In the long run, staying rational and taking advantage of these moments is what separates great investors from emotional ones.
Uh, if you want to get an example of, I mean, this country was close to the brink at that point, and basically Roosevelt got anything he passed he wanted just as fast as they could write the bills there initially, and that was a good thing. With banks closing and people dealing in script and that sort of thing. So nobody wants that to come back, and we've learned a lot more about that sort of thing since the Great Depression. I don't think you'll see an orchestrated credit contraction. Now, you had in 1998, in the fall, when long-term capital management got in trouble, you had a seize up of the credit markets. It wasn't an orchestrated by the Fed type contraction. You simply had people panicked about even the safest of instruments and credit spreads doing things that they'd never done before. And that's rather an interesting example because that was not 100 years ago. It was less than 10 years ago. You had all kinds of people with high IQs in Wall Street. You had all kinds of people with cash available. And you had some really, really extraordinary things happen in credit markets simply because people panicked and they felt other people were going to panic. And you get these second and third degree type reactions in markets. We will see that sort of thing again. It won't be the same, but as Mark Twain said, history doesn't repeat itself, but it rhymes. And we will have something that rhymes with 1998.
Thank you so much for watching. Now, if you want to learn about how you can pick these high quality stocks, watch this video right here.